One of the most valuable lessons about investing I ever learned came from someone I admired growing up. When I first became curious about investing, I had no clue where to begin. So I asked him a simple question: how do you choose the right stocks? His answer stuck with me. He said to think of it like choosing a life partner. At first, it sounded unusual, but it actually makes a lot of sense. When you invest in a company, you're not just buying a number on a screen, you're becoming a partial owner. That means you're entering a long-term commitment. And just like any good relationship, you want it to be stable, trustworthy, and built to last. There's no shortcut or secret formula that guarantees quick profits. Anyone claiming they can predict sudden price jumps is usually misleading you. Instead, the goal is to make informed decisions that improve your chances over time. To do that, you need a clear approach. Broadly speaking, there are two main styles of investing. One focuses on short-term price movements using charts and patterns, while the other focuses on understanding the business itself, its finances, performance, and future potential. The second approach is generally more reliable for long-term investors. A big part of evaluating a company is looking at its financial health. One useful tool is the balance sheet, which shows what a company owns and what it owes. By comparing short-term assets to short-term liabilities, you can quickly judge whether the company is in a strong position to handle its obligations. Another important document is the income statement. This shows how much money the company generates and how much it spends. By analyzing its profit margins, you can get a sense of how efficiently the business operates and how much of its revenue actually turns into profit. Then there's the cash flow statement, which tracks how money moves in and out of the business. A company that consistently generates positive cash flow from its core operations is generally in a healthy position. Spending on growth can also be a good sign, as long as it's done responsibly and not supported by excessive borrowing. But numbers don't tell the whole story. You also need to consider factors that aren't easily measured. For example, how strong is the brand? Do customers trust the company? Is the leadership experienced and reliable? And does the business have any unique advantages that set it apart from competitors? These factors can play a huge role in long-term success. It's also important to stay disciplined. Markets can react strongly to news, and many investors panic when prices fall. But short-term fluctuations don't always reflect the true value of a business. Making decisions based on fear often leads to poor outcomes. Finally, building a strong portfolio means understanding different types of investments. Some companies are stable and generate consistent income, while others focus on rapid growth but come with higher risk. A balanced mix of both, spread across different industries, can help reduce risk and create more stable returns over time. In the end, successful investing isn't about luck or quick wins. It's about patience, research, and making thoughtful decisions for the long run.